Hi everyone, I'm Steve Schneider, the National Marketing Spokesman for Brokers Alliance, or maybe you perhaps know me as Steve Savant, the host of the internet talk show, The Business Insurance Zone. Today I'm going to dip our toe into life insurance, kind of an introduction if you've never really sold it, if you've never really understood it. I'm just going to give you a small introduction into life insurance and see if you kind of appreciate that, and maybe it's someplace that you may want to sell the product. Now, here's an interesting thing. Sir Edmund Halley, I know that you know him as the man who discovered the comet consequently named after him. But one thing you probably don't know about Sir Edmund Halley is he's the one that actually built the first actuarial table that we use to price life insurance on a human, and he made the same model back then 400 years ago. We basically use that same modeling. Now, when I'm thinking about insurance, I'm thinking about three basic items for insurance. One is for protection, or maybe you've heard the phrase indemnification, or maybe the phrase coverage. Another area is for supplemental income. There are many tax advantages for life insurance, and it can be used for tax deferral, and it can be used for tax-free. And on third is inheritance. Life insurance can protect inheritances, create inheritances, and also be able to give money to the charity of your choice or a nonprofit organization that's approved by the IRS. The three basic ideas behind life insurance is pricing how long people live. And that has a lot to do with if the person is male or the person is female. And on top of that, their medical condition. For example, it's cheaper for a female 45 to buy insurance than it is for a male 45. And that's simply because women live longer. Now, when we priced out the Social Security, it was built on the 1941 CSO mortality tables, the Commissioner's Standard Operational Tables, where everybody dies at age 62 and 65, somewhere in that vicinity. So Social Security was built on that platform. Social Security would have plenty of money if people would just die according to the tables. But of course, we've been seeing a huge mortality revolution. And so we went from the 1941 CSO model that we use for life insurance to the 1958 model. That's the model I used when I first came into the business. And then we went to the 1980 CSO, and now we're on the 2001 Commissioner Standard Operational Tables. And if you look at those tables, you can see how long a male and a female non-smoker standard is going to live. It projects it out every year, and that's kind of information that we carry, and happy to give it to you if you need it. Now, one little heads up, the Society of Actuaries just built about 3 years ago the 2008 VBT tables, the valuation-based tables, and they measure on the relative risk of how long a person's going to live, and then we price it effectively. Think about this. The mortality revolution in life insurance is so great that a female age 25, super preferred, which is the highest preferred ranking, if she bought a $100,000 contract for a 10-year period, her $60 policy fee would be greater than her premium. That's how long they expect these young women to live. So if I can stretch a timeline, and you think about this, when I started in the business in 1958 on the CSO, the mortality tables or the maturity dates and endowment dates when a contract ends ended somewhere around age 95. Then we pushed it to age 100. Now we're at age 121. That's the maturity date, and some carriers are actually illustrating all the way out to age 131. Unthinkable. So we're already pushing the mortality revolution. I call it the Methuselah experience. As you remember, he was the oldest person recorded in sacred script. He died at 969. But after the flood, it seems like we lost a huge amount of longevity when it comes to issues of human longevity. And now all of a sudden, we're seeing a whole stretching. The United States is experiencing a longevity, a kind of a revolution in human life expectancy that we haven't seen in so long. In fact, in the year 2000, we had several people that we met that were tricentenarians, people who were born in the late 1800s, lived throughout the 1900s, and then made it into year 2000. In a nursing home that I visit every once in a while, I noticed that it's almost 9-to-1 female to male. So we can see that females live longer, and because of that, their price tag is less. Now, one of the things I mentioned earlier was I used that phrase super preferred. Well, when I came into the business that many 30 years ago, we only had non-smoker and smoker. Now we have so many divisions, and we're parsing your Chem 24 exam, a blood and urine evaluation, where we look at all these areas to see if you're super preferred, preferred plus, preferred non-smoker, standard plus, or standard. 5 different non-rated classifications, all based on your blood and urine exam results. Now, below that is what we call substandard. People who might have medical items, things that are really of a concern to the company, and they charge a little bit more than the average. And depending upon the malady and how sick they are and how old they are, that will then take the table from table 2 to table 3. In fact, we actually go all the way up to table 16 before we decline somebody. It's pretty amazing when you think about it. So health is a big issue. Gender is a big issue. Do you smoke or not? All those things come into the price tag of life insurance. Now, what we talked about earlier was the 3 areas that life insurance really is built for. It's built to indemnify the loss of a family member or a business partner. It's built for tax-free income, and it's also built for inheritance, whether you want to pay estate taxes with it, it's great leverage for that, whether you want to create a legacy for your children, or maybe you want to choose the charity of your choice. When I'm thinking about indemnification, I'm thinking about, do I have a permanent or do I have a temporary need? If I have a temporary need with life insurance, I'm going to use term, and this is how I remember it. Term is temporary expense reimbursement money. It's temporary. So I may only need a 5-year or a 10-year, a 15, 20, 30. Think about this. We now go to 40-year level guaranteed term. Amazing. But what if the liability or the loss of a loved one or a business partner is going to be so great that it's going to be also not only large, but it's going to be forever? It's a permanent liability. And so if I have a permanent, I think of it this way: permanent expense reimbursement money. So I am always asking myself, is it a temporary liability that I'm trying to cover, or is it a permanent liability? Now, in term, as I said, we have 5, 10, 15, 20, 25, 30, even 40-year level term. In permanent, we can go all the way out and guarantee the contract now to age 121. There are many platforms that life insurance uses. One's called Whole Life. Whole Life is a contract where you already have your premium certain, paid. It will be level, it will be guaranteed for the life of the client, and that contract has to be paid every year for the life of the client. Now, there's 2 kinds of whole life. There is participating whole life and non-participating whole life. Participating whole life actually generates a dividend. And in insurance language, a dividend is a return of unused premium. So if the company prices their product and that price tag, actually they overpriced their product, they're able to return the unused portion of that premium, and that is used as a dividend. Other contracts that are whole life don't have any dividends. That's why they're called non-participating. Then about 20-something years ago, we invented a thing called universal life, somewhat combining term with a small cash value account on top of it that was flexible and adjustable according to interest rates. Then we matured from universal life, and then we did variable life. Now we have indexed universal life. We have these basic 4 platforms: indexed, variable, universal, which is current assumption interest rate, and then of course whole life, whether it's participating or non-par. These 4 different contracts are all permanent forms, and they all have their place depending upon what you're trying to get done. So when I'm looking at life insurance, I have to look at it: is it a temporary issue? Is it a permanent issue? And if it's temporary, how long will I need it? And remember, when I'm thinking about term, I may want to be able to convert that. So there's a lot of provisions in term contracts that I want to look at to say, is it convertible? Do they give term conversion credits? Do they allow riders like a spousal rider or a waiver of premium rider or a disability rider? There's so many possibilities that you can put on these platforms, even on term, that will really help you cover all the indemnification scenarios, coverage or protection that you're looking for. When I'm looking at term, I'm looking at, do I have a quality carrier with a quality contract, and will I be able to convert it? When I think about a quality carrier, I'm wondering, what is their AM Best rating? What is their S&P? What's the Moody? What is their Comdex rating? What is their Flitcraft? There's so many things to look at to say, is this a quality carrier, and look at their balance sheet. And because a contract is only as good as the carrier that's behind it. So we want to make sure that we have a quality carrier that has a high rating. And when we're done looking at that and you're thinking about, wow, I think I might be interested in life insurance, there is no other product in the financial community that pays a producer or an investment advisor the way life insurance does. It cannot be sold over the web. We've tried it. Very few people have success over it. It has to be sold by one-on-one FaceTime. And that's why you have to explain these things. And again, we're just giving you a small introduction, dipping your toe into the world of life insurance. Here are some of the things that I look at to cover. One of the biggest ones, of course, is a mortgage. And the first thing I look at when I want to cover, in case somebody dies, is my mortgage predicated on 2 incomes? I think of it in this way. Is it dual income, no kids, or dual income, raising kids? Is the client a dink or a dirk? When I look at this, I'm saying, is the mortgage predicated on both the husband and the wife working? And if so, then I have to get 2 separate policies. I don't even use a rider anymore. I use 2 separate policies because I have 2 earners involved. Now, if I only have a single income, no kids, or single income raising kids, I have a sink or a circ. So is my client a dink, dirk, sink, or circ? It's an easy way for me to remember, always to ask the question, is the mortgage predicated on a single income or is the mortgage predicated on a dual income? Because the mortgage is probably the largest thing I have to indemnify. Now, there's a lot of other things that we can do that are general purposes for life insurance. It can fund a business transfer. It can pay off the mortgage, as I've suggested. It can pay death taxes and other estate settlement issues. It can create an estate. It can also go ahead and replace a charitable gift. Maybe you gave a gift, but you'd like to replace that gift for your children. It can always equalize an inheritance. This is a really good one too for businesses, because let's say one of the children are heavily participating in the business, but the other children are not. And at the end of the distribution, when death occurs, they want to equalize the estate because the person really who's been in the business deserves to get the business, but his siblings feel like they were shorted because the vast majority of the estate was the business. Life insurance is an excellent tool to equalize the estate, and it's one of the key maternal objections to sending money to the next generation, because mother generally wants to make sure that all children were treated equally. So this is a great tactic, and we use this all the time, and that's why I kind of centered on this. It's able to pay off loans. It actually has accelerated death benefits in time of sickness. It could actually fund college and retirement. There are so many great ideas that you can use with life insurance that can bring you to the place where you're helping your client indemnify themselves, whether it's for income, whether it's for inheritance, or whether it's for indemnification, just to protect basic ideas. Again, I'm Steve Schneider, the National Marketing Spokesman for Brokers Alliance, and you can call us at 1-800-290-7226 for further educational vignettes.